Gold refused to drop below $4,700 on a ceasefire announcement. Let that land. A ceasefire, the event that should have triggered a safe haven unwind, and gold held its floor. That is not normal market behavior. That is a market telling you the crisis is not over. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, VP Vance is on the ground in Islamabad. Talks are live. Markets are closed. Gold sits at $4,648. Silver sits at $75.90. Monday opens at a price nobody can predict right now. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today, the Islamabad Accord talks, April 11th, 2026. Vice President J.D. Vance arrives in Islamabad, Pakistan, leading the highest-level U.S. delegation since the Iran conflict began February 28th. The stated objective, a framework for reopening the Strait of Hormuz, and a durable ceasefire between the United States, Israel, and Iran. The 2-week ceasefire was announced April 7th. It has already shown fractures. Israeli strikes on Lebanon continued after the ceasefire declaration. Iran accused the U.S. of violating the agreement within 48 hours. The Strait of Hormuz remains partially blockaded as of this recording. And here is the unusual detail that deserves scrutiny. Gold hit $4,155 intraday on April 8th, the day of the ceasefire announcement. By end of week, gold is sitting at $4,648, a $107 pullback. On a ceasefire, not a collapse, not a sell-off. A $107 pullback from the intraday spike, and then a floor. The timing is what deserves scrutiny, not the pullback. The floor. A market that holds $4,700 through a ceasefire announcement is a market that has structurally repriced geopolitical risk as permanent, not temporary. Think about what that sequence actually means. The ones paying attention already know what to watch next. Before I show you the full macro picture, consider this number. The U.S. 10-year Treasury yield hit 4.29% this week. That is near a 3-week low. Treasury yields have been falling. Bond markets are pricing in some probability of de-escalation and eventual rate relief, and yet gold is not selling off. When bonds rally and gold also holds, that is not a normal correlation. That is a pattern. Let's build it out. Now let's build the full picture because the Islamabad talks do not exist in a vacuum. The U.S. Bureau of Labor Statistics released March CPI on April 10th. The number, 3.3% year-over-year, the highest reading since May 2024. Monthly CPI rose 0.9% in March, the largest single-month increase since June 2022. That data comes directly from the BLS, not a secondary source. Core CPI, which strips energy and food, came in at 2.6%, up from 2.5% the prior month. The energy component of that CPI print reflects only the early weeks of the Iran conflict. The full pass-through of a partially blocked Strait of Hormuz has not yet shown up in the data. March CPI is the first wave. The Federal Reserve held rates at 3.50 to 3.75%. FOMC minutes released this week from the March meeting explicitly stated that policymakers were concerned the Iran conflict could sustain inflation and potentially require further tightening. The CME FedWatch tool shows approximately 0 probability of an April rate cut. Markets are pricing one cut at most in 2026. Consumer sentiment, per the University of Michigan survey, plunged to a record low in April. 1-year forward inflation expectations moved sharply higher. The rate of inflationary pressure is not moderating, it is compounding. The data is doing the talking. The ones who said the Iran conflict would be transitory for inflation, they are not saying much right now. And here is what makes that picture even harder to ignore. The US dollar index, The DXY closed the week at 98.65, down over 1% on the week, below the psychologically significant 99 level. A weaker dollar is structurally positive for gold and silver, both priced in USD. At the same time, the 10-year yield at 4.29% means real yields remain elevated. A structural headwind for non-yielding assets like gold. That is the tension. Dollar weakening, bullish. Real yields elevated, bearish. Gold at $4,148 is the market's current answer to that tension. Silver at $75.90 with a 12% Shanghai premium is the physical market's separate answer. That is not a contradiction. That is the setup. And before anyone treats that setup as a directional green light, setups built on geopolitical binary events can resolve in either direction within hours. Setups can take a long time to resolve, or they can resolve violently before anyone reacts. What this tells you is the structural picture. The timing, specifically the Monday open, is a completely separate question. Anyone who claims to know the timing is selling something. Now the Islamabad talks, because this weekend is no longer a macro backdrop, it is the primary variable in the gold and silver market right now. Here is the number most people are not focused on. Approximately 21 million barrels of oil per day transit the Strait of Hormuz. That is roughly 20% of global oil supply through one choke point. The strait remains partially blockaded. Brent crude is holding above $100 per barrel. Every day Hormuz stays disrupted, another 0.9% monthly CPI print becomes more probable for April. That math is not speculation. It is arithmetic. Markets are still pricing the ceasefire as fragile but holding. Look at gold at $4,148, down only $107 from its post-ceasefire spike. And tell me what probability you put on a clean, permanent resolution this weekend. When markets start pricing the reality of a collapsed Islamabad accord, gold reprices toward $5,000 on renewed safe haven demand. Silver faces a short-term binary, initial sell-off on global growth fear, then recovery on physical squeeze dynamics. Oil reprices above 115s, DXY reclaims 101. That is the historical pattern. Every time a major energy choke point has remained disrupted beyond 30 days, inflation expectations have not normalized until the route reopened. It has not been different yet. Gold Western spot at 4,148, silver Western spot at 75.90, Shanghai Gold Exchange physical silver at approximately $84 to $85 per ounce, a $9 premium, approximately 12% above COMEX. Short-term picture is a binary. If the Islamabad talks produce a credible Hormuz framework this weekend, oil drops toward $90 before Monday's open. DXY weakens toward 96. Gold gaps down briefly toward $4,500 on war premium unwind, then recovers as rate cut probability revives. Silver outperforms on the recovery. Its industrial plus monetary profile benefits from a weaker dollar and reviving growth expectations simultaneously. If the talks collapse before Monday, gold gaps toward $5,000 at the London Open. Silver initially volatile below $70 on growth fear before the physical squeeze narrative reasserts. DXY spikes above 101. The 10-year yield moves back toward 450%. That is the only short-term read that matters right now. As for trading through this weekend, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold or silver does at Monday's open. Nobody can. If you think you know, good for you. A live binary geopolitical event with markets closed is not a trading setup. It is a gap risk event. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this weekend trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. A successful Islamabad accord triggers war premium unwind. Gold gaps down toward $4,500 before any recovery can establish a floor. The Fed remains on hold at 3.50 to 3.75% with zero April cut probability. A persistent headwind for non-yielding assets regardless of geopolitical outcome. Consumer sentiment at a record April low signals demand destruction risk, historically bearish for silver's industrial component. The bull case is equally real. Gold held $4,700 through a ceasefire announcement. Central bank demand floor and de-dollarization structural bid are confirmed as permanent price supports, not speculative. Silver COMEX registered inventory at 76 million ounces against 576 million ounces open interest, a 13.2% coverage ratio deep inside the 15% stress threshold, exists independently of weekend geopolitics. March CPI at 3.3% is the first wave of Hormuz pass-through. April data has not yet captured continued disruption, meaning inflation risk is structurally underpriced in current market expectations. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Here is the one sentence that frames everything I showed you today. Markets are closed. Islamabad talks are live. And two metals are sitting at structurally significant levels, with a binary outcome deciding Monday's open before most investors are awake. Don't take my word for it. Verify every number I gave you today. Check the data yourself. U.S. Bureau of Labor Statistics CPI data at BLS.gov. Federal Reserve FOMC minutes at federalreserve.gov. CME Group FedWatch tool at cmegroup.com FedWatch. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook, do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.